Hi everyone. In this project, our group as business consultants appointed to assist the management of Paperless Sdn Bhd in analyzing the company's financial position through cost volume profit, which is CVP analysis. This analysis is crucial as it helps the company evaluate how changes in costs, selling prices, and sales volume will affect net profit. Using the information provided, we will identify the company's cost structure, contribution margin, break-even point, and the impact of sales commission on profitability. Through this analysis, we aim to propose strategies that will help the company achieve its target net income to sales ratio of 30% for the year 2025 and support future business planning.
Assalamualaikum. My name is Nur Aznalisa. Question 1, CPP analysis. Selling price per unit. We begin by calculating the selling price per unit. In 2025, the company recorded total sales of 1,800,000 ringgit from 19,000 units sold. By dividing total sales by total units sold, the selling price per unit is 20 ringgit, which forms the basis of the CVP analysis. Total variable cost and variable cost per unit. Next, we calculate the total variable cost. The variable costs include variable cost of goods sold of 1,900,000 ringgit and sale commission of 50% of sale, amounting to 270,000 ringgit. Third, the total variable cost is 1,170,000 ringgit, or 30 ringgit per unit when divided by 19,000 units. Total feed cost. The total feed cost is calculated by adding fixed cost of goods sold, feed, advertising cost, and fees general and administrative costs. This results in a total fixed cost of 261,000 ringgit. Contribution margin and contribution margin ratio. The contribution margin per unit is obtained by subtracting the variable cost per unit from the selling price. This given a contribution margin of 7 ringgit per unit. The contribution margin ratio is 35%, meaning that 35% of sales contribute toward covering fixed costs and profit. Break-even point in unit. The break-even point in unit is calculated by dividing the total fixed cost by the contribution margin per unit. This gives a break-even point of 37,285 units, which represents the sale volume need to cover all costs. Lastly, the break-even point in amount is calculated by multiplying the break-even unit by the selling price per unit. This results in a break-even sale amount of 745,700 ringgit. Question 2. First, the target net income is determined. The projected sale amount is 1,800,000 ringgit. Therefore, 30% of the 1,800,000 ringgit equals 540,000 ringgit, which represents the target net profit. Next, the required number of units to be sold is calculated using the following formula. Fixed cost plus target profit divided by contribution margin per unit. The company fixed cost is 378,000 ringgit, while the target profit is 540,000 ringgit, giving a total of 980,000 ringgit. This total is divided by the contribution margin per unit of 7 ringgit. Possible action 1. Increase promotion and marketing. The company can focus on digital marketing, social media, and promotion campaign to raise brand awareness and attract more new customers. Expand sales channels by strengthening online sales on targeted corporate and customers such as office, school, and universities. The company can reach a wider market and boost sales. offer sale incentive and bundle promotion. Provided sale incentive and bundle promotion can increase customers to buy more product in a single purchase, thereby increasing the average sale per customers. Target bulk and institutional customer. Focusing on bulk and institutional customer can secure large and stable orders, increasing overall sales and reducing dependence on individual retail customers.
Strategically explore another option. If the company cannot increase the number of units sold, the alternative strategy is to increase the selling price. Earn an operating income of 30% of sales at the current sales volume. We calculate the required contribution margin. Contribution margin needed per unit is 10 ringgit and 30 cents. This means the selling price needs to be increased from 20 to 33 and 20 cents per unit. However, this strategy comes with risk. Raising the price may cause customers to buy less, especially if they are price sensitive or if there are many competitors in the market. Therefore, increasing the selling price is only suitable if the product has strong brand value, better quality than competitors, and unique features that justify the higher price. For question 4, we are required to evaluate whether the company should proceed with its product improvement plan by analyzing the financial impact of the proposed changes. First, let us look at the assumptions given in the question. The company plans to improve product quality, which will increase the variable cost to 55% of sales compared to the current level of 50%. In addition, fixed advertising expenses will increase by 6,000 ringgit due to an advertising campaign aimed at boosting sales. As a result of these improvements, the company expects its sales to increase by 200%, meaning that total sales will become 3 times the current level. We begin the analysis by calculating the new total sales. The current sales are 1,800,000 ringgit. With a 200% increase, total sales become 5,400,000 ringgit. This significant increase in sales volume is the main driver of the company's improved profitability under this plan. Next, we calculate the new total variable cost. Since variable cost is now 55% of sales, we multiply 5,400,000 ringgit by 55%. This gives us a total variable cost of 2,970,000 ringgit. Although variable cost increased substantially, this increase is proportional to the higher sales levels. After that, we calculate the new contribution margin. Contribution margin is obtained by subtracting total variable cost from total sales. Therefore, 5,400,000 ringgit minus 2,970,000 ringgit results in a contribution margin of 2,430,000 ringgit. This amount represents the funds available to cover fixed costs and generate operating income. The next step is to calculate the new total fixed cost. The original fixed cost was 378,000 ringgit. With the additional 6,000 ringgit in advertising expenses, the new total fixed cost becomes 384,000 ringgit. Compared to the increase in contribution margin, this rise in fixed cost is relatively small. Finally, we calculate the operating income by subtracting the total fixed cost from the contribution margin. 2,430,000 ringgit minus 384,000 ringgit give an operating income of 2,046,000 ringgit. This represents a substantial improvement compared to the company's previous performance. In conclusion, despite higher variable and fixed costs, the product improvement plan leads to a significant increase in operating income. The sharp rise in sales more than offsets the additional costs. Therefore, the company has strong financial justification to proceed with the product improvement plan.
For question 5, the company need to evaluate two different sales strategies for the upcoming year: maintaining external sales agent or hiring internal sales staff. The main objective is to compare the cost structure and determine the most cost-effective option based on project sales. Under option A, the company continues using external agents with a 20% commission rate. This means selling expenses remain fully variable with an estimated commission cost of 360,000 on sales of 1.8 million. In contrast, option B changed the cost structure by introducing fixed salary costs through internal sales staff while reducing this commission rate. For option B, the company incurs annual fixed salaries of 108,000 and additional variable commission cost of 90,000, resulting in a total cost of 189,000. Overall, option B offers significant cost saving and better cost control compared to option A. For the advice, the company should not approve the staff request for 20% commission. Instead, Pepperleaf Sendirian Berhad should proceed with the CEO plan hire its own sales staff. Lastly, for the justification, for example, cost efficiency. Total sales related expenses when employing in-house staff amount to 189,000 while 360,000 if we follow the agent's suggestion of 20% commission. This means an annual saving of 162,000 and the higher contribution margin. Reducing variable commission from 50% current or 20% request to 5% essentially doubles the contribution margin per unit.
Since our strategic recommendations are: first, improve product quality to support higher pricing and stronger customer trust. Second, reduce dependence on high commission agent to lower costs and improve sales control. Third, expand sales channels like online platform, corporate client, and books purchase to grow revenue. By applying these strategies in the company, our company can increase profitability, improve
In
efficiency.
conclusion, the CVP analysis conducted shows that managerial accounting information plays a vital role in supporting effective business decision-making. The analysis provides a clearer understanding of how changes in cost, prices, and sales volume influence the company's profitability. Based on the result, we have proposed several strategic actions to help Pepperleaf Sdn Bhd achieve its target of 30% in income to sales ratio. We hope that this recommendation will assist the management in planning operations, controlling costs, and strengthening the company's profitability and competitiveness in the future.